Every single day, millions of people open their brokerage apps, scroll through hundreds of ticker symbols, and have absolutely no idea what they're looking at. They buy a stock because someone on social media said it was going to moon. They buy because their coworker mentioned it at lunch. They buy because they heard the company name on the news and it felt familiar. And then they lose money, and they blame the stock market. But here is the truth nobody wants to say out loud. The stock market is not the problem. The decision-making process is the problem. Because right now, today, there are specific stocks sitting at compelling valuations with strong fundamentals in sectors that are positioned to grow massively over the next 3 to 5 years. Stocks that serious investors are quietly loading up on while everyone else is distracted by noise. Let's change that starting right now. If you're new here, make sure to subscribe and turn on the notification bell. Okay, now, why most people buy the wrong stocks before we talk about what to buy. We need to talk about why most people get this completely wrong. There are 3 deadly mistakes retail investors make over and over again. Mistake number 1, chasing performance. They see a stock that went up 200% last year, and they buy it, expecting it to go up another 200%. But by the time a stock has already run that dramatically, the easy money is usually already made. You're buying someone else's profit. Mistake number 2, following the crowd. When a stock is all over social media, all over the news, all over every financial YouTube channel, that means the information is already priced in. The crowd is almost always late. The smart money moved months earlier. Mistake number 3, ignoring valuation. A great company and a great stock are not the same thing. Apple is a phenomenal company. But if you bought Apple at its peak valuation in early 2022, you watched it drop nearly 30% before recovering. Buying a great company at the wrong price is still a bad investment. The investors who consistently make money in the stock market do the opposite of these 3 mistakes. They look for quality companies that are temporarily out of favor. They move before the crowd, and they obsess over valuation. Keep those 3 principles in your mind as we go through today's sectors and stocks. Sector number 1, artificial intelligence and technology. Look, I know what you're thinking. Everyone is talking about AI. It is everywhere. Isn't it already overpriced? Here is the nuanced answer. Some AI stocks are absolutely overpriced, trading at valuations that require decades of perfect execution to justify. But others, particularly the companies providing the infrastructure that powers AI, are still at very reasonable valuations relative to their growth trajectories. Think of it this way. During the California gold rush, most gold miners made very little money. But the people selling pickaxes, shovels, and jeans to the miners, they got rich reliably. Every single time. The AI gold rush is the same. The companies building the infrastructure, the semiconductors, the data centers, the cloud computing platforms, the networking equipment. These are the pickaxe sellers of the AI era. Semiconductor companies that manufacture the chips powering AI computing. Cloud providers whose infrastructure every AI company depends on. Enterprise software companies embedding AI into products that businesses cannot operate without. These are not speculative bets. These are structural positions in the backbone of the next technological era. What to look for specifically? Revenue growth above 20% year over year. Strong free cash flow generation. Competitive moats that are difficult to replicate. Reasonable price to earnings ratios relative to growth rates. What investors call PEG ratio. The AI infrastructure build-out is a multi-decade story. The companies at the center of it, bought at the right prices, have the potential to be the defining wealth-creating investments of this generation. Sector number 2, healthcare and biotech. This is one of the most powerful sectors for long-term investors and one of the most misunderstood. Here is why healthcare is so compelling right now. The global population is aging at an unprecedented rate. By 2030, all baby boomers will be over 65. The demand for healthcare services, pharmaceuticals, medical devices, and health technology is going to grow relentlessly for decades regardless of what the economy does. Healthcare is what investors call a defensive sector. People do not stop needing medication or medical care during recessions. They do not stop needing insulin because the stock market drops. This gives healthcare stocks a stability that most sectors simply cannot match. Within healthcare, there are three subcategories worth focusing on right now. First, large-cap pharmaceutical companies with strong dividend histories and deep drug pipelines. These are your stable, income-generating positions. Some of the best dividend aristocrats in the entire market are pharmaceutical companies. Second, medical device companies. The intersection of technology and medicine is producing extraordinary innovation. Robotic surgery, continuous glucose monitoring, AI-powered diagnostic imaging. These are growth stories with real, recurring revenue. Third, select biotech companies with late-stage drug candidates. This is higher risk, but the reward potential when a drug gets FDA approval could be extraordinary. The key is looking for companies with multiple pipeline candidates, so a single failure does not destroy the investment. Healthcare belongs in every serious long-term portfolio. It is the rare combination of defensive stability and genuine growth potential. Sector number 3, the energy transition. The global shift from fossil fuels to clean energy is not a political position. It is an economic reality backed by trillions of dollars of government and private investment across every major economy on Earth. And here is what makes this sector so interesting right now. After a brutal 2-year sell-off in clean energy stocks, driven by rising interest rates and changing political winds, many of the best companies in this space are trading at valuations not seen since before the massive clean energy boom began. This is exactly the kind of setup that value investors dream about. Quality companies, temporarily beaten down, long-term thesis completely intact. Solar energy companies that are now cost competitive with fossil fuels in most of the world. Wind energy operators with long-term government contracts locking in stable revenue for decades. Battery storage companies solving the intermittency problem that is the last major barrier to full renewable adoption. EV charging infrastructure companies, because regardless of which EV brands win or lose, every electric vehicle needs somewhere to charge. The other angle on energy that many investors overlook: traditional energy companies that are actively transitioning their business models. These companies have the capital, the infrastructure, and the regulatory relationships to be major players in the clean energy future, and many of them pay substantial dividends while you wait for the transition to play out. Energy transition is a 30-year story. Getting positioned in the right companies now, while they are out of favor, could be one of the most rewarding long-term investment decisions of this decade. Sector number 4, financial services and fintech. Banks and financial companies are not the most exciting investments on the surface, but they have been quietly some of the best long-term wealth creators in market history. And right now, they present a particularly interesting opportunity. Here is the current landscape. Traditional banks are benefiting from a higher interest rate environment that significantly boosts their net interest margins, essentially the profit they make on every loan. Regional banks in particular, after a rough period in 2023, have largely recovered and are trading at historically attractive valuations relative to their earnings. But the more exciting opportunity within financial services is fintech, financial technology companies that are disrupting and transforming how people and businesses handle money. Digital payment processors handling trillions of dollars of transactions annually. Buy now, pay later platforms reshaping consumer credit. Blockchain and digital asset infrastructure companies. Not the speculative cryptocurrencies themselves, but the infrastructure companies processing and securing digital transactions. Robo-advisory and wealth management platforms democratizing investment access for millions of people who previously had no access to professional financial guidance. The global fintech market is projected to grow from roughly $200 billion today to over $900 billion by 2030. That is a staggering growth runway, and the companies positioned at the center of that growth have the potential to deliver extraordinary returns. Traditional banks for stability and dividends. Fintech disruptors for growth. Combined, financial services gives your portfolio both income and upside. Sector number 5, consumer staples, and dividend champions. Now I want to talk about the boring stocks, the ones that never get mentioned on Reddit, the ones that never trend on financial Twitter, the ones that nobody makes exciting YouTube thumbnails about. These might be the most important stocks you ever buy. Consumer staples companies make the products people buy every single week regardless of economic conditions. Toothpaste, soap, food, beverages, cleaning products, toilet paper. These are not discretionary purchases. They are necessities, which means the companies selling them generate remarkably consistent revenue through every recession, every market crash, every economic storm. And many of these companies have been paying and increasing their dividends for 30, 40, 50 consecutive years. Think about what that means. These companies kept raising their dividends through the dot-com crash, through the 2008 financial crisis, through the COVID pandemic, through every single economic disaster of the modern era. That is not luck. That is the power of an irreplaceable business model. The valuation case for consumer staples right now is compelling. After several years of underperformance relative to growth stocks, many of the best consumer staples companies are trading near their lowest valuations in a decade on a price-to-earnings basis. For investors who want steady income, inflation protection, and the ability to sleep at night regardless of what the market is doing, consumer staples dividend champions are an absolutely essential portfolio foundation. Boring? Maybe. Wealth building? Absolutely. Section 7. The framework. How to decide what to buy now here is the most important part of this entire video. Because knowing which sectors are attractive is only half the equation. The other half is knowing how to evaluate any specific stock before you buy it. Here is the exact 5-step framework professional investors use. Step 1. Understand the business. Before you look at a single number, ask yourself this question. Can I explain what this company does in 2 sentences? If you cannot explain the business simply, you should not own the stock. Warren Buffett calls this staying within your circle of competence. If you do not understand how a company makes money, you have no business owning a piece of it. Step 2. Check the financial health. You're looking for 4 things. Revenue that is consistently growing year over year. Earnings that are growing at least as fast as revenue. Free cash flow, meaning the business actually generates real cash after expenses. And a manageable debt load, because companies drowning in debt are fragile when economic conditions change. Step 3. Evaluate the valuation. The 2 most important metrics for most investors are the price-to-earnings ratio, the PE, and the price-to-earnings to growth ratio, the PEG. A stock trading at 40 times earnings might be cheap if it is growing 50% per year. A stock trading at 15 times earnings might be expensive if growth has stalled completely. Context is everything. Step 4. Assess the competitive moat. Does this company have something that makes it extremely difficult for competitors to take its customers? A brand that people are loyal to? Technology that took a decade to build? Network effects that make the product more valuable as more people use it? Switching costs that make customers reluctant to leave? The stronger the moat, the more durable the investment. Step 5. Consider the macro environment. Is the broader economic environment favorable for this sector? Are interest rates moving in a direction that helps or hurts this business? Is regulation increasing or decreasing in this industry? Macro context does not override great fundamentals, but it helps you understand timing and risk. Run every single stock you are considering through these 5 steps. Every single one. Without exception. This framework will prevent more bad investment decisions than any stock tip ever could. Section 8. What to avoid right now, just as important as knowing what to buy, is knowing what to avoid. Right now, in today's market environment, there are specific types of stocks and sectors that carry elevated risk that many retail investors are not adequately pricing in. Highly speculative and profitable growth companies. Companies burning through cash with no clear path to profitability are extremely vulnerable in a higher interest rate environment. When money is cheap, the market is forgiving of losses. When money is expensive, the market demands results. Be very cautious with companies that have never turned a profit. Heavily indebted companies in rate-sensitive sectors. Commercial real estate companies, certain utilities, and highly leveraged businesses face significant headwinds when interest rates remain elevated. The debt servicing costs eat directly into profits and can quickly turn a seemingly stable company into a financial emergency. Meme stocks and social media darlings. If you're getting your stock tips from social media influencers, Reddit threads, or viral videos, stop. The people promoting those stocks are almost always selling while you're buying. By the time a stock is going viral, the informed investors are already exiting. Single country emerging market bets without deep research. Geopolitical risk is at its highest level in decades. Companies with massive exposure to unstable political environments carry risks that are genuinely difficult to quantify. Avoid these categories. Protect your capital first. Because the most important rule in investing, one that Warren Buffett has repeated for 60 years, is simply this: never lose money. Rule number 2. Never forget rule number 1. Section 9. Building your portfolio the right way. Now, let's put this all together into an actionable portfolio approach. For most individual investors, a diversified portfolio built across multiple sectors gives you the best combination of growth potential, income, and protection against any single sector underperforming. Here is a framework for thinking about portfolio allocation across what we covered today. AI and technology for growth. This is your highest growth, highest volatility allocation. Keep it meaningful, but sized appropriately for your risk tolerance. For most investors, somewhere between 20% and 35% of a growth-oriented portfolio. Healthcare for stability and growth. A true hybrid gives you defensive characteristics and long-term growth. Suitable for 15% to 25% of most portfolios. Energy transition for long-term thematic exposure. This is a patient, multi-year position. Size it according to your conviction and time horizon. 10% to 20% for most investors. Financial services for income and value. Particularly for investors who want dividends alongside growth. 15% to 20% allocation makes sense. Consumer staples dividend champions as your foundation. This is your ballast. Your sleep at night money. Your recession protection. 10% to 20% depending on your age and income needs. And always maintain a cash reserve. Having 5% to 10% of your portfolio in cash gives you the ability to buy aggressively when a market gives you extraordinary opportunities. And it will. The market always eventually gives you extraordinary opportunities. Diversification is not just a defensive strategy. It is an offensive one. Because when one sector struggles, your other positions continue compounding. And when opportunity appears in a specific sector, you have the allocation flexibility to take advantage. The best stock to buy today is not a ticker symbol. It is not a hot tip. It is not whatever is trending on social media this week. The best stock to buy today is a quality company in a growing sector at a fair valuation that you understand deeply and that you have the conviction to hold through volatility. Invest intelligently. Invest patiently. Invest consistently. That is how wealth is built. Not overnight, not through luck, through knowledge applied with discipline over time. If this video gave you real value, please hit the like button right now. It genuinely helps this channel reach more people who need this information. Subscribe if you have not already. We publish new financial education content every single week. And drop a comment below. Which sector are you most interested in right now? I read every single comment, and I would love to know where your head is at. Go invest smart. I will see you in the next video.